How's it going out there? It's October 7th. I'm Frank Curzi, host of the Wall Street Unplugged podcast, where I break down headlines and tell you what's really moving these markets. So we got a great interview set up for you with the one and only Andrew Horowitz, who is the president and founder of Horowitz & Company, who's a currently smart analyst, also incredibly handsome, has, I don't want to say the second best podcast in the world, or the first, called Disciplined Investor. Andrew, how's it going, man? How's everything?
Hey, Frank, what's happening, man?
I know you're just sitting there listening.
Stutter step.
You know what? It's so funny. It's so funny because, yeah, I did that. Like, I've been doing this. How long have you been doing your podcast? I think I started a little bit after you. You've been doing it long.
Yeah, I was in 2007. Yeah.
Okay, so I think it was like 2008 when I took over for Kramer and did it the whole time. Then I worked at Stansberry. They wanted me to do a live broadcast there from a podcast, right? And I had like a guest. I think it was Stephanie Link at the time. And I started it and I said, Frank Curzi, Wall Street Unplugged, where I break down headlines. And the whole freaking crowd was like, tell you what's really moving the markets. I'm like, wow, they actually like this. I was like, I guess I got to keep it now. So
you're like a major like rock legend that all he has to do is point a microphone in the way of the audience and they start singing the song.
I don't know about that, but yeah, I hear you. So let's get right into it here. I mean, the markets are really all over the place. I'm sure you're getting, just questions from clients. I'm getting questions from subscribers, and it's tough to see because we're not getting like that quick move down and then buy the dip.
Right.
It's 500 here, 500 there, up, down. Now September was like the first month out of the last 7 that the market went down, but we're seeing some real indications of things where the foundation is cracking a little bit. I mean, the 10 years obviously rising. Right. You're seeing Evergrande was an issue. Supply chain issues are definitely for real and getting worse. Inflation through the roof, labor shortages. But yet there are companies that are able to pass on these costs and have pricing power. It seems like a very confusing market to most people where they're nervous, which sometimes is a good thing when everyone's not leaning to one side of being bullish or bearish. But there is concerns out there. I don't want to see how are you handling this and what are your thoughts on what's going on in the markets?
I think one of the big things that we have to understand and recognize right now is some of the reason we're seeing this volatility is that we are once again in that time frame when you have all these Congress and congressmen and senators and everybody involved in government looking to get the limelight ahead of the sausage making process. Until I think every single person in Congress and maybe even government goes in front of a microphone, I feel like we're not going to see an end to this whole thing. Right now, the big debate, without getting too political, is really all about politics. It's not about whether or not we should increase the debt ceiling. Everybody knows we should increase the debt ceiling. This is not a question. But the political gamery and what's going on, pushing the Democrats to move towards a simple majority is going to set the stage up for the Republicans when, if in fact, they win back the Senate, at least to the point where we are today, at kind of a slight advantage, having them the ability to do so, because now it's like, well, you did it. Now we could do it. So what's happening is this push me, pull me, and this whole market movement is all based on this big concern where Janet Yellen said, hey, you know what? If we do not increase the debt ceiling in the next 2 weeks, we can go through a default. That's not going to happen. We know that. The problem is that the shenanigans that are being pulled by the government, every single time there's some kind of a action like this, the same thing happens. It doesn't change earnings. It doesn't change economics. It just causes a lot of problems and consternation. Earnings are the big problem right now. As you mentioned at the top where you talked about inflation, I think that's really what we should be getting into, the idea of whether or not the excess cost can be passed on and whether or not it is inflation due to blank supply or demand or combination is really the big issue right now. And I think that really the supply chain thing is really the nuts and bolts about what's happening with prices. And that's a big concern. And that's going to play out because we have, significant amount of earnings expectations that are built in right now. And that, so you add that all together. And then one more thing, the cherry on the top, Frank, is the loss of confidence in the Fed. The confidence has been lost slowly but surely over time when they just kept on telling us that, no, don't worry about it. We can keep on pumping money in the system. It's not going to be a problem for inflation. Oh, there's a little inflation, but it's transitory. Oh, maybe it's not as transitory. And then finally, oh, and by the way, some of the gang here has been trading on the news and the information that we know about. And even though they shouldn't be, there's a conflict of interest. So confidence in the Fed, which is a mainstay of any of the market movement right now, because a lot of what we're doing is fueled by the Fed, I think is really hurting investors right now.
All great points. Let's take, I don't know if we'll get to one at a time, but one of the biggest issues, I think, when you're saying earnings season, we're getting to the holiday season, right? The holiday period. Right now, inventory levels are incredibly low. You're seeing fights for container ships. We saw Coca-Cola just announce, yesterday that they're changing from container ships to dry bulk cargo, which is amazing, right? Amazing. That is amazing when you think about it. And they're saving costs, even though dry bulk prices are up 5x at $5,000 right now. And you're looking at container ships are what 2,000 a year ago, and they're like over 14,000 or something, like 7x, right? So they are saving
21.
money. But
I have friends that are paying 21,000.
That's I mean, we all have great sources in this industry. If you do have, not we all, but if you just talk to these people and listen to people who are in this industry, it is insane. You look at the holiday period is supposedly the greatest money generating, revenue generating, not so much earnings with all discounts sometimes, but that's a major period for these companies. How are they going to get the supply? And is it something we need to worry about? Because we're seeing it where I've seen just in the past 3 to 4 weeks, I'm talking about 3M, GE, Honeywell, tons of companies say, listen, labor shortage.
Nike, Walmart, right.
Sherwin-Williams. I mean, you can keep going, go FedEx. And all this happened in the past 3 or 4 weeks. And it just leads me to believe that, these are not, this is a much, much bigger problem than I think everyone believes right now. It's going to result in uncertainty, which the markets hate uncertainty.
Right.
So how do you play the market going in? Because buying something right now, if they come out and warn, which we're seeing, right? We're seeing companies miss estimates and warn right now, the warning period. It's hard not to warn because it's just on the safe side, be like, hey, we might not. Like, look what Delta did. Delta warned a month ago, and then this month they raised their estimates back and said, hey, demand's back, right? So if you warn at these valuations.
The airlines were just downgraded.
And the airlines downgraded, yes, which it's confusing as hell. I agree with you. So, how do you position yourself, say, as an individual investor? I mean, do you buy into this market? Do you take small positions? Because right now, it seems like from a risk-reward standpoint, it's very, very, very dangerous.
Well, I think the market has to be split up, though. That's the big issue. Right now, retailers, for example, you have a situation going on in Vietnam where the COVID lockdowns have shut down a lot of factories. The only way that you can actually work is if you go and live in the factories. Now, over time, if you remember what happened, we shifted our production of things like, shirts and cotton wear and things of that nature from China to Vietnam, right? We moved them because we felt that it was a lot more beneficial for pricing. Well, we moved this whole block. It was like all excited about Vietnam, and now Vietnam is shutting down. What happens? What happens is you don't get your clothes out of there, and the problem for like companies like the Gap and Old Navy and Walmart, for that matter, and other places that get their imports from Indonesia, Malaysia, Vietnam, that are and Cambodia, that are having problems with production. Add that to the fact that even if they did get that container out, which now costs the final selling company, the retailer, much more money due to the fact that the container prices are more expensive. You get to the port of Los Angeles and you're waiting. You're stacked up 80 boats deep because there's not enough truck drivers, which is bizarre, by the way. The whole thing about what's going on in the supply chain is from bizarro land, right? The school children that can't get to school because many of the people that were laid off decide to maybe start working for Amazon or Uber, and there's not enough school bus drivers. The same thing that you don't have truck drivers that got into different places when they were out of the job for a while. So the problem with the restart of the economy is very uneven, what they say. It's because it doesn't necessarily just go from off to on. Some of the things are just not there. And when you look at the problems that you're mentioning, and while I may want to go and buy a particular, shirt or suit, it may not be there because of all of this. Therefore, the store doesn't get the revenue, and I'm not necessarily going to just buy something else in its place. So there is the potential for a slowdown due to the fact that there's no supply, and that's a problem.
So that's just one of the problems. What is the Fed's playbook right now? Okay, because this is one of the other things you mentioned with the Fed and the supply chain issue. Because the supply chain issue is causing inflation, so it's hand in hand. What's the Fed playbook? And listen before you respond, because the Fed right now, it has a choice where, okay, no tapering, keep rates low. Inflation, you're risking inflation getting out of control, especially if we pass the infrastructure bill, right? Because I have no idea how you can't ship anything right now. Imagine what raw material prices going through the roof. We're seeing it one by one, right? Now it's cotton, it was lumber, it's everything, everything. So, or do they go ahead and taper and also start raising rates, because that's going to have an environment where you're still going to see inflation, but now you're going to see very slow, growth is going to slow, right? So then you have stagflation, which is a major concern. But what's the Fed's playbook here? Because it sounds like they're like praying that, wow, we thought it was going to be transitory. We know it's not transitory. What do we do? And I don't know what they're going to do, because this is a one solution. If inflation gets out, that's the one thing the Fed can't control by throwing money at it, right? They could bail out anyone they want, like they did in the past. But this is the one thing where you have to do the opposite. You have to take money out of the system. You have to raise rates. You're going to see massive deleveraging, liquidity come out of the market. It's going to be insane. It's going to be insane where, risk off, right? Risk off environment. A lot of companies could get hurt, but I'm curious to know what the Fed playbook. I don't know what they're going to do. And the longer they wait, they're backing themselves in the corner. Here you go.
I have an announcement.
You know it.
I have clarity. I'm not kidding about this either.
Okay.
Every once in a while you have clarity on it hit me only a couple of days ago. Seriously. When I heard one of the Fed speakers talk about that they are going to start to taper and they will complete the tapering by let's say the mid part of 2022. That's what they said, right? Mm-hmm. I'm thinking to myself, they're going to taper. They're going to go from where we are at $120 billion per month right now, and they're going to start moving over to tapering and turning off quantitative easing by the middle part of 2022. How does that work? And then I realized something. They're talking about tapering. Tapering. It's going from something big to small. Taper your pants. It goes from the wide leg down to a small leg. And what they're talking about is tapering, not discontinuing. The taper may only be $20 billion of total asset purchases that they reduce down $5 billion per month over the next 4 or 5 months. You follow what I'm saying here? They will continue because they don't know how to do anything and they have to due to the fact that the government is issuing this much debt. They're going to continue quantitative easing. They're going to taper, and the taper program, which is just a small reduction, will be done very slowly, and it will be just a small amount. I'm probably figuring they're going to go down on the outsides $40 billion a month to get in line with what they were doing during the financial crisis of $80 billion a month. That's what I think they're going to do. It's not going to be, which is still enormous. And I don't think that's going to slow down the economy that much. It will create a liquidity issue for certain areas, but I think that will have the impact of actually benefiting markets in the long run, not allowing them to get over the top bubbly. So,
and the reason why this is important, right, because we're talking economics here, is it's a top-down approach. Because if you could figure or try to figure what the Fed's going to do, because we know a lot more than the Fed. We see it real time. A lot of these guys at the Fed, a lot of these guys on TV, they're on TV all the time. They're hanging out in rich circles. They don't see the labor shortages. Your favorite places are now closing. They're not even like operating 80% capacity and you're waiting there all day. They're closing because they can't get people to work there, right? So we're seeing prices through the roof everywhere. We know that. But if the Fed does start tapering, or if we see inflation continue to go out of control, I mean, we're kind of seeing it now, right? What are the areas? Financials do good in higher interest rate environments. We're seeing inflation at the beginning right here with oil prices really taking off. And then you're also seeing the hit in technology, which is showing inflation because these are the guys that generate the most money from the CapEx spending from everyone else, right? And their margins are already high, so they can't cut their margins like cyclical companies. So people say, why technology companies directly impacted? Because it affects the advertising budgets, it affects capital spending, the CapEx across the board. And these companies, as rates rise, are going to have to shrink their budgets, which means less money is going to go to advertising and Facebook. So all these tells are telling us inflation. Are these the places that we need to buy, or is this how you're positioning yourself, or is it more than that?
I've been leaning. So we have several different strategies, right? We have a kind of a long short strategy, which, by the way, we're using cash as a buffer because it's almost impossible to hedge out a portfolio right now of positioning when you have a market that's up 500 one day, down 500, down 300, midday up 400, then back down to even by the end of the day, right? And these are all signs of late stage market madness, along with what's going on with the Congress and the Fed. I think you have to lean if you're in a diversified approach and you're thinking about protecting for inflation, as we do in our global allocations, for example, as we do with Investology, which is a diversified portfolio, you lean towards the value for 100 different reasons. One being that they have underperformed for the last 5 years, and a catch-up trade is almost inevitable, which is happening with energy. Look, if you don't think that all of this is inflationary, look what's happening with oil. There's not a supply issue or demand issue. It's simply the fact that there's speculative action going on. OPEC's not pumping anymore. And even though we know that the need for oil has severely been reduced and cut by airlines not flying, cars not really out there, trucks not so much out there. We just talked about the ports. And all the things that are going on, it's insane that we have that Brent is over 83 and WTI is 76 and change. Mm-hmm. Some of this, and natural gas has doubled this year. Coal prices through the roof. All of this that is going on is the excess amount of liquidity in the markets and the inflationary environment that is right in front of everybody's face. The Fed won't admit it. Their job is not to admit it. Their job, you've been around, Frank. Let me ask you something. When's the last time you saw the Fed say, things aren't looking so good?
Actually, I don't really think I hear a lot of CEOs say that often until like recently about everything. But everyone always talks positive about their company. They say, oh, yeah, that's why I don't like talking to CEOs. And I'm a CEO. I'm the same way. You're going to talk about the positives. But, you're right. You don't see them, especially in the political world as well, right? They're not going to backtrack and say, hey, we got this wrong. Never happens.
How things? Miserable. Every client has left me. It's terrible. Hey, why don't you do business with me? That's not how it works, right?
Yeah.
You don't see that.
Never. No, never backtracking. So, okay, let's get into some of the positions here. So, you did offer some speculative positions last time that didn't work out as well. You have one of the best performances, being on this podcast for such a long time. So you're going to get some wrong, some right. That's okay. It was Workhouse and Didi. I kind of like Didi as a pick,
and I mentioned
it would,
Frank, I hate to interrupt your show. Sorry, Frank, but you can interrupt my show anytime. But I did say these were highly speculative. These were kind of one-off specialties. Mm-hmm. I said, these are kind of like these wild cards. And it was, if one thing goes right, they could do really well. And there was a little pop on the beginning. But yes, those sucked.
And look, I mean, it happens to all of us, right? If you look at your track record of being on this podcast, it really is incredible. So, and I know you're always fair because you actually brought that up and said, hey, I mentioned this last time. And that's what I love about you, right? Because for me, too, I like addressing my losers more than my winners. That's what you learn the most. But now you're looking at this environment, everything that we talked about. What are some of the areas you're looking at? Individual names, which you love giving out. What are some of the things that are attractive going into an earnings season that's kind of like a little scary right now?
So a couple of thinner traded positions that are interesting. And if you think about everything and you agree with what we just talked about, the higher cost for commodities and goods, the problem with supply chains, the problem with Asia, that all, I start thinking about where's that all go? Well, you got companies like a Wayfair or an RH, Restoration Hardware, the furniture companies, they're smack dab in the middle of problem zone. So it would seem to me that there's a lot of pain ahead for these guys. And if we have a slowing economy, it even gets, worse. If we have a reopening, Wayfair, maybe not selling so much furniture to do a pop-up office in your house. And even though their margins are high because their furniture is awful, okay, cheap, and they mark it up. I have yet to, I don't think, maybe once or twice, but generally anything I've ordered from Wayfair, I've either sent back or they said, don't bother sending it back, just keep it. It's something's broken or chipped or warped, or I'm not kidding about this either. So they obviously have, and I can tell you a lot of people, talk to your friends and ask them, hey, have you ever tried to return something to Wayfair? What do? They just say, keep it. Or they'll send it back to you and give you $100 off and send you another one. Something crazy like that. So they obviously have pretty good margins when it comes to what's going on with that. RH also, the opposite side of the spectrum, really great furniture, extraordinarily high prices. An ottoman's like $5,000. You've been in there, right? RH.
Mm-hmm. Yes. So, yes, of course. Yep.
How much can people buy after a while, and if there's a supply chain issue getting it, that's a problem. On the other side of it, so that's kind of like some short ideas. On the other side, kind of Netflix really knocking it out of the park with the fact that they're continuing and have the ability. They have pricing pressure, the pricing power. Think about it. if Netflix does a $1 a month, 50 cents a month, a $2 a month increase in your fees, what are you going to do? Nothing. And it's kind of like a frog boiling in a pot, unless they do something absurd. But even if they went $5 a month, what are you going to do? Nothing.
Nobody's going to cancel. And the pricing power that they have is incredible. They do. And I don't think Disney has it. Disney doesn't have it because the new content isn't coming out on that platform.
No. Right.
They were just like, let's add as many subscribers for free as we can. And people bought into that model. And now you're seeing that slow down. But when I look at streaming, when I look at Netflix, there's one difference. The major actors, actresses love it. They all come away loving it, saying this is the greatest experience, and they lock them in, and they give them whatever they want. They treat them great, and they all love that platform where they have amazing new content. AT&T is another one where both of those guys are spending $20 billion a year on new content, and Disney, I mean, their cash flow is still terrible. They're still getting, impacted with international travel and stuff, but they don't have that constant cash flow coming in, especially like an AT&T, which has $30 billion, $27 billion in free cash flow coming in. But when I look at Netflix, just a clear winner. Reed Hastings is the most competitive guy you'll ever know. I remember when he was, took down Blockbuster. They went to Blockbuster during the credit crisis, and they were looking to get sold, and they were laughing at them, and then he wanted to destroy. That guy's one of the most competitive. That's why when Disney comes in, he goes on TV. He's like, "Oh, it's good. More people get into our markets." He's like, we're murdering these guys and we're going to bury
more
them.
Fun, more blood.
And that's what I like about it. But yeah, Netflix is just, Squid Game, right? I haven't seen it yet. Have you been watching it? Is it good?
I'm in episode 2. I think it's entertaining. The idea that you go in and play a game. Everybody knows the basic principles. Go in and play a game. And unbeknownst to you, it's kind of like we'll either create incredible freedom and financial security for you, or you're going to die. So it takes you through life and gets you close to some of the people. Kind of an interesting. And the one difference also is you mentioned that Netflix, the actors really like, and the people that they come away saying great things, as opposed to Disney where they sue them. The actors sued Disney.
And not only was Scarlett Johansson sue Disney, but Disney came out and like trashed her. They were just like, well, you should have more respect for COVID. I was like, whoa. I was like, you do not do that. Yeah, she's extremely powerful, right? I mean, that's a powerful actress in Hollywood, man. You don't want to piss that person off. But there is one more name. Other things. Go ahead. There's two other real quick, one idea, a genre. Is CRISPR technologies, CRISPR editing, the biotech area. We've seen a lot of moves of companies that were doing the vaccines, et cetera, and the mRNAs and all that, and Pfizer, BioNTech, et cetera. But I'm kind of digging the whole, and I've liked this for a long period of time. They have a lot of opportunity. If you look at the fundamentals, you're not going to really find anything right now. But if they make a hit, which they're kind of starting to get some things going on here, two companies, Edit, EDIT, and CRISPR Technologies, CRSP, are interesting. And finally, the one that you think you want to talk about is Affirm. Now, we talk about the shopping situation. We talk about what's going on. Affirm entered into the old world of installment payments. That was like back in the days when you buy a suit or whatever from Macy's, right? You'd go and you'd say, well, put it on layaway. I'll pay you $20 a month. I'll pick it up in 6 months. That's great. Or installment plan, where you could actually take it, and they would do this. Now, MasterCard and Visa have had this for years, but it wasn't as cool. It wasn't as workable where you could have a zero interest rate on very short-term loans. The retailers love this. Amazon recently made an announcement they're bringing Affirm in. Affirm could do like a buy now, pay later, or the fancy way to say is BNPL is a way to do it. Affirm basically gets a cut of the deal from the retailer up whatever's negotiated. They also get potentially some money up from 0% on some items and some agreements to 10 to 30% on longer installment plans. It's a micro lending platform essentially for specific goods, and it's not backed by anything. When you buy it, it's just a signature. They'll do a background checks. They have great algorithms. And today, or yesterday, I guess it was. Yes, yesterday, the announcement came late, but Target is now using Affirm, and the stock is jamming up as well. So you got great earnings that came out, Amazon, Target, and they don't need, it's not like Walmart would say, oh, Target's using Affirm, we're not going to. Yeah. Other companies, even competitors, can use Affirm because the theory is I can go in and say, oh, I have $100 to spend today online on something. I'm going to buy
a skirt, or I'm going to, not me, but my wife, or, I'm going to buy a certain item that I want for fishing, and I have $100. Well, all of a sudden that 100 I can spread out because I was going to spend 100, but I'm going to spend 400 because I'm going to pay 100 a month for 4 months. Right. Mm-hmm. And this way it kind of can really bend. This is why a lot of the players want this, as opposed to, okay, of course they could spend more on MasterCard and figure it out on their own, but they could put a little thing on there and say, only pay $25 a month for the next 4 months. Click this button and it's a seamless transaction. AFRM. Just added, added more to my client portfolios this week.
Okay, so there's usually like a format. Whenever we actually we're going on the podcast, we'll just send just bullet points. Say, hey, this is the things that we're talking about, and you send some ideas. One idea that you didn't mention that you had on your list was a company that I have to tell you that I never heard of before, and it's Asana. And, this is a pretty amazing company where, health productivity platform. I never heard of this company before. It has a $20 billion valuation. I'm looking at this freaking chart. Holy cow. I guess it's because, when it must have IPO'd,
IPO'd, right,
in 2020. Uh-huh. But man, I mean, what this is, just interesting. I love to see the move. And of course, it's come off like most stocks, the past month or so. But just to see this move here, it is pretty incredible. It's, is that a name that you say you're looking into? But I like just new ideas I never heard of. But what these guys do enable teams to orchestrate work, basically increase productivity. Obviously, this is a platform that's working because you're seeing more demand, you're seeing earnings explode, and you're seeing, that stock price follow.
So this is one of those stocks and one of those companies that I've actually used their product for a number of years, and I was too dumb to buy it on the IPO kind of thing, right? Because they really didn't have earnings, et cetera, all the different things that go into that play, right? Let's see how it plays out. And then you saw that chart. It was like a moonshot. So Asana is a great product. It's used by a lot of developers and other teams. Basically, what you could do is something like this. Let's say that you and I have a particular project that we're working on. Let's say this podcast, every time that I come on the podcast, you give me, it's the Horowitz-Curzio podcast. And every time you want something there, you put a little note in, okay, here's your assignment, whatever. You can spec it out. You can use calendaring and all that. Inside, very simple to use. Track all of that. Maybe I put some notes up there, a screenshot up there. All of that is just dedicated to our work environment on this podcast, right? So you say, hey, we're coming on tomorrow. What graphics, what things you want? I upload it from my desk. You get it. We can have multiple people on the same team. We can complete it. We can post it. We can postpone it, add more under the project, add more tasks. I use that with all the developers I work with, and it really works well. I have a 5-person, and I don't pay anything. It's 5 people you get for free. Under 5,
that's pretty cool.
So you can get a free.
For coming in.
Good project management. You got to get used to it, but once you do, great product. I think it's a great buyout candidate, and that's why the stock's moving rather than just the underlying fundamentals.
Yeah, no, it definitely makes sense. So as always, love the ideas. We have 1 minute, just 1 minute left. So I always love giving you time to just, talk about your company. If people want to get in touch with you, how could they do that?
Well, hang on.
Oh, no. I was coming off to put your website on, but I just saw it. Go ahead. Yes.
Nope. There you go.
I love the mustache. I love the mustache so much. It's so awesome, man. It's so like Tom Selleck. I love it. If you guys, we do this on, most of you know that we have our YouTube channel, but that is so awesome. But The Disciplined Investor, love the book, love it. And then you have, I have your website up right now. If, so disciplinedinvestor.com.
Yeah, basically, if you want to work with us, we have a variety of different strategies and programs available from Investology, which starts at $10,000. Diversified, use a band of different range of risk. Our TDI managed growth strategy, which is traditionally a long short. Right now, we're leaning on the long side, generally speaking, with a buffer, and our global allocation. So it's all there. And you can check that all out over on that. Yep, gives you all the stuff there and how to get in touch with us. Plus the podcast, of course, DH Unplugged Tuesday nights, live and on your favorite podcast catchers, as well as the Disciplined Investor, been running for 14 years now.
That's
and
incredible.
second to only one, which is Frank Curzio's fantastic podcast.
I know. We met that long ago, right? We talk about podcasts.
Yeah.
You tell people, you say you have a podcast, like big. I got one too. I'm like, no. We have a podcast for 13, 14, 15 years. And now everybody has one. It's so funny. Everybody asks me advice. I'm sure you get it too. And I tell them all that. I'm going to tell you exactly how it works and how you can stay on long, but you're not going to do it. and sure enough, they're gone in like a couple months. They just don't commit.
A lot of work.
It's a lot of work. It's a lot of energy. It's getting on good guests. It's, staying ahead of the market. It's being original, but it requires a lot of time and commitment. I love it. I know you love it, but if you don't love it and you're just trying to do it, it never works, right? It never works with anybody.
Right.
So love to see that we're both in this game, and thanks for coming on, man. I love you. I've been friends for a very, very long time. Love all the ideas. And if you do happen to go on that amazing trip, I know I thought it was a guarantee, but you may be heading to Egypt. Not too sure. Hopefully you are. It's going to be awesome. Definitely enjoy that. But and I'm sure I'll talk to you.
And I'll just let you know, around the corner, Frank, around the corner is sailfish season is about to start up. Have you caught a sailfish yet, Frank?
No, but I'm definitely coming to your house because every time I'm sick of you sending me like these massive fish all the time, and I always see them, and I'm like, man, I gotta go. So yes, it is.
We're gonna get you a sailfish, Frank.
No, definitely. I'm definitely. When does it start? When does the season start?
Well, usually it wouldn't be for where you are, but up here when we officially call it when the first cold snap happens, when you like the day that you walk outside, you go, wow, it's kind of cold out. That day is the start of sailfish season. It's probably mid-November.
All right. I'm in. I'm definitely in. Seriously, I'm definitely in.
We'll get you there.
All right, man. Thanks so much for coming on, guys. Thanks, buddy. That's it for me. Questions, comments, feel free to email frankcurzioresearch.com. That's frankcurzioresearch.com. Really appreciate all the support. And I'll see you guys next week. Take care.